odds of a rate cut in June falling from a month ago by around 6%, leaving investors increasingly split on whether we'll just see that first cut in June. And so far, resilient economy and sticky inflation reports have investors assessing where the economy is going to land. With more here, we have Stephen Ricchiuto, Mizuho Securities U.S. Chief Economist, Fixed Income. Thank you for joining us here today. Just your thoughts on where we are with the Fed and the rate cuts. Maybe you're listening to our discussion, the ECB kind of front-running the Fed. What are your thoughts about the overall situation?
Well, I think what you're seeing is an environment where you have a Federal Reserve that clearly wants to cut rates. Let's be honest. The Fed is dominated by doves. It is not dominated by inflation-fighting hawks. It's dominated by people who want to keep the labor market tight in an attempt to maximize social welfare from that angle, as opposed to constraining inflation, which had been the prior approach of the Federal Reserve to maximizing social welfare. So this is a changed Federal Reserve. So they want to cut rates. The problem is they want to cut rates, but the economy is standing in its way. So people ask me, with your no rate cut call for 2024, aren't you fighting the Fed? And my answer is very simple. The Fed is fighting the economy. In particular, they're fighting the American consumer. And that's a fight that I would not want to get involved in.
So, Stephen, when it comes to your base case right now for your forecast, where does that risk lie? Does it risk almost to the upside in some sense?
Well, the risk to the upside on the growth scenario, certainly the risk to the upside on the inflation scenario as well. Because if the Federal Reserve was to cut interest rates without the data justifying it, then you could get into an environment where you begin to embed a 3% inflation psychology into the marketplace as opposed to a 2% inflation psychology. And that laterally shifts up the fair value trading range for the 10-year note, effectively from 3 3/4 to 4 1/4 to 4 1/4 to 5 1/4%. And that's a real problem in terms of the outlook for the overall economy, because clearly it will have significant negative effects on the ability of households to purchase homes.
Yeah, when we talk about central banker jargon, one of the terms is long and variable lags, and the Fed is coming off of a hiking cadence we haven't seen in roughly 4 decades. What are those lags, and are we still at risk that the tightening that has happened so far, that's been on hold, but that happened as recently as a few months ago, that will finally kick in even more and take the economy to the downside? What are those risks there?
Well, one of the key things you have to understand is this is a very unique tightening cycle, because the Fed has been telegraphing all along that it wants to cut interest rates. Every time they've gone through the process of stepping up the rate hike scenario, they then promised that they would cut rates. And they continue to promise that they cut rates, and they continue to telegraph to the market how much they want to cut rates. And the net result is financial market conditions are not reflecting the degree of monetary policy tightening that you have at the very front end of the curve. And then further dampening, though, the ability of monetary policy to transmit itself to the economy is the fact that nobody borrows at the front end of the curve anymore, other than some regional banks who are somewhat dependent on brokered deposits. Everybody else funds in the structured credit area of the economy, and that structured credit area of the market is really benefiting from the forward rate reductions priced into the market, and therefore it's aiding financial market conditions being so accommodative and offsetting the Fed's rate cuts or the Fed's rate hikes scenarios.